to pay their workers, or to pay their taxes, or their rent, or their electricity bill, or any of the other various expenses that they have. Because the US dollar is not the currency in China, Germany, or Saudi Arabia. So what does the business do? They go to the central bank. Let's use China as an example. They go up to the People's Bank of China, and they say, Mr. Central Banker, by the way, they're almost all misters. Mr. Central Banker, I've got all these funny green pieces of paper with a lot of dead presidents' pictures on them, and I would like to have RMB so I can pay my workers. And the central bank says, oh, okay, and they make that exchange at a particular exchange rate, and we'll talk about exchange rates later in the term. And now all of a sudden the central bank is sitting on a big pile of US dollars, which they can do one of two things with. They can simply sit on it, in which case their earnings will be zero. Or they can buy US government securities that have some sort of interest rate associated with it, and therefore a positive rate of return. So the Chinese central bank then sends financial capital, US dollars, back to the United States in exchange primarily for US government debt instruments. Notice that at this point, financial capital, all those US dollars the People's Bank of China is sending out, become a net financial capital outflow. China has made a loan to the United States government. They've also invested in dollar-denominated financial assets. Trade surplus ends up meaning net financial capital outflows. Okay? Got to work that way. Now let's turn the coin over and think about what happens if you have a net export deficit. This would be the United States. So for the United States, the net export deficit is about $500 billion per year. So what does that mean? That means we're buying from the rest of the world $500 billion worth of goods and services more than we're selling to the rest of the world. Well, if your income is from selling and your expenses are your buying, that means your expenses are greater than your income. How can you buy more than your income? You have to borrow the difference, right? So who are you going to borrow it from? It actually turns out with international trade, you largely end up borrowing it from the people who sold it to you. In this case, China. So financial capital is going to flow into the country as we borrow more and more money from China. So we want to buy Chinese goods, and guess what? More than they want to buy American goods, they end up, the Chinese that is, end up lending us the money to buy that excess with. Kind of an interesting relationship that it creates between the U.S. and China. What would happen? Yes. Yes. No. So the question was, do corporate inversions, where American companies buy a foreign company and then reestablish their headquarters in the foreign country in order to have lower taxes, will that change net exports and therefore inflows and outflows? The answer to that is no, because where the business is actually taking place is not changing. What is changing is tax liabilities, and what will then change is, with the change in ownership, is net factor income. So GDP doesn't change, but GNP does. So all this corporate inversion stuff actually has very little to do with any of the stuff that we're talking about today. Okay, so this chart, notice it looks similar to the savings chart that we had before. But rather, what I've got on here is this purple line is net export share of GDP. In the top two lines, the blue line is net saving as a percent of gross national income, and the orange line is net domestic investment as a share of gross domestic product. So what you can largely see is that where saving is greater than investment, that is, the blue line is above the orange line, the purple line will be positive. And then once we switch, starting in the early 1980s, where now, broadly speaking, investment is greater than saving, what you see is net export goes into deficit and follows, especially right in here where it gets very large differences, you can see that the net export side really deteriorates. So again, showing that net exports as a share of GDP, the national saving rate, and investment are highly correlated by the identities that we've set up. Now, it's not an exact match because I didn't find the exact data that corresponds, so there's a little bit of apples and oranges in here, but you can't see the basic trends. Now, one of the other things that might be of interest to us, and I only use might advisedly, because since I'm saying it, it will be of interest to us, is that what happens to not national saving, but rather private saving? How are private savings being used? And one of the reasons that we want to look at this is that if you go back to those charts on national, private, and government saving, what you typically see is government saving is much more volatile than private saving is. So we want to ask ourselves, then, well, what's the implication of that? So we saw that national saving is used to fund private investment and a net export surplus. Since national saving is private saving plus government saving, then private saving must be used to finance private investment, domestic investment, net exports, and any government deficit. Notice that most of the time we've had government budget deficits. So one of the things that we can think about then is we've got the private sector saving a whole bunch of funds. The government comes in and takes whatever their deficit is, whatever their funding needs are. The bigger that deficit, the less will be available to fund domestic investment and a net export surplus. An alternative way of thinking about that is looking at this equation and assuming that private saving is fixed at some number. And that, just to rub it out, let's eliminate the net export surplus, hold that constant. So if the budget deficit gets bigger, that is, this is a larger negative number, then it must be true that private investment has to go down. Larger budget deficits with a fixed private saving and fixed net exports means that we will have less private domestic investment. No way to get around that. We'll be seeing over the next couple of weeks that private domestic investment into productive assets and the size of the capital stock are very important for determining an economy's both level of income per worker, what is our economic standard of living, as well as how fast the economy can grow over time. So if we have adverse effects then on private domestic investment because of a large budget deficit, it has consequences both in the short run as well as in the long run. But we'll look at that more closely next week. Okay, we know where national saving comes from, private saving, government savings, but how is it actually determined? In other words, how does the private sector figure out how much they want to save? How does the government figure out how much they want to save? So if we look at our national saving equation, or identity, y equal minus c minus g, now what that really means is that we need to have an equation for each of these three variables. Right? If we have an equation for economic output, and an equation for consumption, and an equation for government purchases that explains consumers' behavior and government's behavior, then we can figure out how much they're going to spend, and we know what's left over is their saving. Well, we already have an equation for economic output. Right? This is a production function that we talked about before. So economic output is simply equal to total factor productivity plus some function of the capital stock and the labor force. The plus signs underneath A, K, and L indicate that all three of these variables positively influence economic output. If you increase total factor productivity, if you increase the capital stock, if you increase the labor force, you will increase economic output. Right? Positive relationships. Now, we need to explain consumption as well, and for that we use a consumption function. So, bless you. Here's a generic form for a consumption function, where consumption, total consumption, over here on the left, is equal to something we call autonomous consumption, C bar, plus some function of disposable income and the real interest rate. And again, you can see that we're going to set up autonomous consumption so that it has a positive relationship. Hopefully it makes sense to you that if your income goes up, your consumption goes up. Positive relationship. Also, if your taxes go up, but your income stays the same, your consumption goes down. And finally, if the real interest rate rises, that you will now be faced with a higher cost of borrowing. With a higher cost of borrowing, you'll borrow less. Remember, downward sloping demand curves. If you borrow less, you'll spend less. So we should have an inverse relationship between consumption and the real interest rate. A more specific form of the consumption function we could write as follows. And you may remember this from Econ 1. Or maybe not. Where consumption, total consumption, still equals autonomous consumption, plus something called the marginal propensity to consume, times disposable income, minus a parameter, so some value called C, times the real interest rate. Now in the aggregate, the marginal propensity to consume is less than 1. So the marginal propensity to consume simply tells us if we get an increase in our disposable income, what percentage of it do we spend? So suppose you're making $1,000 a week, and your boss now gives you a 10% raise. So now you've got an extra $100 a week. Taxes haven't changed. What we want to know is how much of that extra $100 do we spend? So if you actually spend, say, $80 of it, your marginal propensity to consume would be 0.8. So your income went up by 100, your spending went up by 80. What happened to the rest of your income? Goes into saving. Right? So income went up by 100, your current income went up by 100, your current spending went up by 80, so private saving had to go up by 20. Okay, the difference. And again, this C term here is simply a parameter. It's some number that tells us how sensitive is consumer spending to changes in the real interest rate. How sensitive is consumer spending to changes in the real interest rate? Now, earlier we talked about consumption having three components to it: durable goods, non-durable goods, and services. And we said that durable goods are those big, expensive items that last a long time. Cars, trucks, boats, private airplanes, but also furniture and appliances, things of that nature. Much of those types of expenditures are actually financed. That is, the consumer borrows money in order to make the purchase and then pays the money back over time. Again, how much you're willing to borrow is going to depend upon, is the real interest rate high or low? When the real interest rate is low, you're willing to borrow more because your monthly payments will be small. When the real interest rate is high, you're going to borrow less because your monthly payments are going to be much higher. Well, if you borrow less, the reason we borrow is to spend. So higher real interest rate, less borrowing leads to less spending. So that C term is simply telling us how sensitive is that relationship? How big a change do we need in the real interest rate to get a particular change in consumption? So that's a consumption function. Now let's go back to our autonomous portion. So again, autonomous is simply another way of calling a variable exogenous. So really what we want to think about is what variables other than disposable income and the real interest rate affect consumer spending. What variable or variables affect consumer spending other than disposable income or the real interest rate? The three that have been recognized as having the biggest impact are wealth, expected future income, and consumer confidence. When people feel wealthier, they have a tendency to spend a larger share of their current income. Right? So if you own a house or you own a big stock and bond portfolio, and the value of your portfolio goes way up and you feel a lot wealthier, even though your paycheck hasn't changed, you're likely to spend more. The same thing with expected future income. If you expect to get a big raise next year, you might actually start spending more now, knowing that you're going to get a big raise next year. Right? You don't have to wait till next year to actually see it show up in your paycheck. You can start to spend a little bit more freely today by saving less. Right? Current income minus current spending. Your spending goes up and your current income stays the same, your saving will change. And finally, consumer confidence. How optimistic or pessimistic do we feel about the economic environment? The more optimistic people are, the more likely they are to spend more freely out of their current income. We saw the opposite of this in 2008 and 2009. When the economy was imploding, everybody was nervous. And so even people who had very, very secure jobs spent less money, a smaller portion of their current income. Their confidence in the economy's ability to recover and the government's ability to do anything positive about it were at fairly low levels. So how optimistic or pessimistic one is can also have a big influence on how much spending out of current income takes place. Okay, we also, if we're going to have disposable income, we need to have a tax function. In here, we're going to use a very simple tax function. We're going to say that the government actually affects tax rates in a way that they're determining tax revenues. Now, this isn't terribly realistic, but it helps keep the model at this stage fairly simple and straightforward, and we'll try and relax this later in the semester when we talk about fiscal policy. But for now, let's just assume that taxes are an exogenous variable. In essence, the government determines the level of tax revenues rather than tax rates. We're actually going to make the same assumption about government purchases, that the government determines what the level of purchases are going to be, independent of what else is happening in the economy. Again, it's not completely realistic, but at least it keeps the model simple for our purposes right now. So when we make all of these adjustments, what we end up with is, and make some substitutions, is a new equation for national saving. We still have income, Y, minus, there's our consumption function, minus government purchases. But notice that now, national savings, we can say, depends on economic output, autonomous consumption, taxes, the real interest rate, and government purchases. And you might also notice that we're subtracting consumption. So if you go back to the consumption function, what you'll see is that consumption was inversely related to the real interest rate. But because we're now subtracting it, that means that saving, national saving, is positively related to the real interest rate. So we have a positive function right here between the real interest rate and national saving. This particular relationship we also refer to as the supply of loanable funds. These are the funds that are coming into the financial system that can be used to be lent out. So what does this look like? Let's put the real interest rate on the vertical axis and saving, or sometimes referred to as desired saving, on the horizontal axis. We just said that this relationship is a positive one. So that national saving equals economic output minus autonomous consumption minus some function of disposable income and the real interest rate minus government purchases. So this is our desired saving function. Again, notice what it says. If the real interest rate is fairly low, you're not going to get much in the way of saving. But as the real interest rate rises, individuals and businesses will now want to save more. And so we would be moving up in this direction along the desired saving function. Now remember how this works. When the real interest rate goes up, the cost of borrowing rises, people borrow less, consumer spending goes down, lower consumer spending with income that's fixed will actually lead to more saving. Okay? So it's a cost of saving argument rather than saying that there's a higher rate of return to saving, therefore I'm going to do more. We want to think about this as a cost of borrowing. Okay? So now we know what determines national saving. We have to look at our production function, we have to look at our consumption function, and we have to look at gross government purchases. Now notice that we also call this the supply of loanable funds. So these are the funds that are coming into the financial system that can then be reallocated out to borrowers. So we need to figure out where the borrowers are. And the borrowers are businesses who make investments. Because the investment in physical assets that businesses undertake have a long lifespan, they are financed over the course of that lifespan. So we're going to use a very simple investment function at this level. So total investment equals an autonomous portion and a portion that depends upon the real interest rate. And a portion that depends upon the real interest rate is going to come in a negative way. Now let's think about what's in that autonomous investment portion. So here, what autonomous means is what are the other factors that could affect investment that is not